Good morning. It is June 21st, 2019. I'm Kirk Spano, and I am in Las Vegas. I have the monster stack of the World Series of Poker starting for me in just a few hours. So we will be quick here today. I was going to do this on Thursday, but as I just told somebody off air, I woke up a little bit late on Thursday morning by about a half an hour, and it was too late to get rolling by the time I was rolling. Poker's going good. You can see the Poker Investing in 3 Weeks in the Desert blog going right now. I'm up to day 11. Today is day 12. And should be an interesting day. I practiced at Planet Hollywood, and I needed the practice because I played cash poker for pretty much an entire week downtown and built my bankroll up, which is, something that we all need to do through our jobs is save money. And when we build our investing bankroll, one of the tools that we've used has been the selling of cash secured puts. So it's a way for us to generate income by selling a put on a stock that we'd be happy to own at a little bit lower price. And I'm going to start out just talking about scaling into stocks here because I think that it's something that we should talk about regularly, particularly for new subscribers. When we scale into a stock, we generally want to take a initial position that's very small. And if you have an account that's big enough, generally more than $50,000, you can do this, but closer to 100,000 is better. You'll want to also sell a put for the same stock at a lower price a month or two out. And those will be your first two scaling in prices. And an example I would give you would be, let's say, SunPower. SunPower is a stock that we've bought in the sixes and in the sevens that is now in the tens. So we've done pretty well on that one. SunPower is a stock that I've said I think can reach $100 per share because I expected them to change their business model and go asset light, which is what they're doing, and becoming an expert in installations on the commercial and residential side, which is what they're doing. There is massive upside in solar. I'm not going to argue why that is. Read some of the articles, but the growth rates are well over 20%. At some point, we'll probably see a period where the growth rates are in the 30s. We have laws changing all over the world that are requiring alternative energy, and solar is the leader there because it doesn't have the physical constraints that wind has. So while wind gets better and better and is deployed more and more, the reality is that even right now, solar has flipped the chart, so to speak, and become about 2/3 of alternative energy deployments today. Just a few years ago, it was only a third, with wind really beating it pretty handily. Those two lines are crossing, and solar by next year is going to be about 2/3 of alternative energy deployments, which are growing rapidly. Why, when we have a conflict in the Middle East and the price of oil is going up, am I talking about alternative energy? Well, we'll get to that in a second. Let's get back to the puts. So if you bought SunPower at $7 a share and then sold a put at, say, $6 a share a couple of months out and received maybe 50 cents a share in premium, and that's pretty close to what a lot of people did, then because the price of SunPower never made it back down to 6, that option expired, and your cost basis was reduced by about 7 or 8%. I think that transaction is fairly common for a lot of people. And now that the price of SunPower is over 10, you have a stock with a cost basis somewhere in the sixes. That's a pretty nice feeling. A lot of people were able to write a second batch of SunPower puts at 7 when the stock moved up a little bit, and those options are expiring today for a lot of people, for me included. So that is another 50, 60, 70 cents. I think I got almost $1 for those. I'd have to look. So we have a cost basis in a lot of cases on SunPower below $6 a share. SunPower again is over 10 right now. Will it pull back a little bit? Maybe. But if it does pull back into the 9s, especially if it gets very close to 9, I would take that opportunity to sell puts within like an $8 strike price and take another 30, 40, 50 cents. On solar stocks, you get a lot of volatility, so the premiums are high. If you trade the RSI, which is real easy to do, and you only sell the puts when the stock is oversold, with an RSI near 40 and falling, then you're generally going to do pretty well. The concept of selling puts is a good one, and that's especially good if you don't want to commit a lot of money quickly. One of the things that I say over and over again is that you want to scale into your stocks. By selling the put, that pauses you. It gives you sort of a built-in control on how fast you are buying, and it slows you down, and that's good because a lot of people scale in. They think they're scaling in because the stock dropped 3% or 5% or 10%. We live in a world where stocks move 20, 30, and 50%, and that's not new. Stocks have been moving 20, 30, 50% in either direction for a very long time. What you're hoping to do is find a stock that has a longer-term trend up, and you can use that volatility to accumulate as you learn more and more and more about the stock, as you see the company execute, as you see their markets develop. When I say scale in, I'm talking about maybe you buy your biggest piece on a 20 or 30% pullback. Sometimes, in the case of oil stocks, you get a 50% or 60% pullback. That's what we've experienced in the last few years as the chart for oil stocks has just gotten worse and worse and worse. It looks like oil stocks have stabilized and are building a base and probably should rally at some point. Again, in that case, we want to focus on those Permian stocks where the cheapest operations are. As we learned earlier this week and last week, the Oklahoma basin, the Stack Scoop, which I've been skeptical of in the past, is not developing as quickly as people thought. Why is that? There is a geography in Oklahoma that's harder to drill than the Permian or the Bakken, and they have earthquake problems. So the companies that are in the sweet spot in shale oil are Permian, followed by the Bakken, followed by Eagle Ford, followed by Stack Scoop, followed by Niobrara. I forgot Powder River Basin. I kind of think of them as Bakken. They're not. Powder River Basin is probably better than Stack Scoop at this point, on par with Eagle Ford probably. So, but they get more oil up there. So that's something to think about, is which shale plays do you want to be in. Again, lean towards the Permian plays. I think the Occidental merger with Anadarko was outstanding. They are selling their global assets, and they will probably sell some of their domestic assets as well. Ultimately, I think Occidental will be primarily focused on the Permian and a few other plays, but will become a very lean company relatively quickly. So that brings us to today, and we have a drone down, right? So let's take a look at some of the headlines, just on some of the things that I subscribe to. I subscribe to foreign policy. headline is about the drone, about Iran. Oh, not signed in the Barron's right now. Let's see what their headlines are. Well, they're telling us the Dow 30,000 could come quicker than we think. We'll talk about that in a second. Here you go, Iran. And their third quarter forecast over at Stratfor. This is something that when I get back in town next week, I will focus on. I'm going to write a pretty lengthy mid-year letter, turn it into a series of articles, and I will cite third quarter forecast from Stratfor, which is usually pretty interesting. They have an article which shows the naval updates for the U.S. These are always interesting. As you can see, quite a bit of firepower in the Middle East right now. The Economist, Iran, and they have a special article this week about Texas and California driving policy in the United States. What's interesting about that is that Texas is turning pretty purple, and that is going to be a battleground state, if not in 2020, pretty soon. So that'll be interesting to see. I like the idea of it being a battleground state versus being one direction or the other. I think most states should be battleground states because I think both sides, and I know that folks think I'm pretty liberal, but I do think that both sides have a lot of valid points. And that's important when we think about our investments, which is why I talk about it. If we get bad tax policy that is repressive, then we get less economic growth. If we get bad education policy, then we don't have the skilled labor force that we need. If we get social policy that's repressive, then we have major legal issues gumming up the works. So there are a lot of things that we need to find the common ground on, and sometimes principle for the sake of principle isn't really productive. We have to pick those spots where principle, above all else, offers some productivity for us. Zacks, how we can profit from the Middle East tensions. I've already talked about that a million times. And then Oil and Gas 360, something that I subscribe to. Rystad, I subscribe to Rystad as well. Haven't seen that. These guys, I don't see the word Iran on their front page. Yeah, these guys are. There you go, Iran, article number 2. So if we took a look at Rystad, what would they be talking about? See my list of subscriptions. If you see Kirky Do out there, it's usually me. So this is something, I'm just on the free one right now. I took the paid trial. What this resource does is it helps me break down which oil and gas reservoirs are doing the most production. We can look at it by well, which is pretty amazing to me. So in any case, let's talk about an Iran war. I talked about this almost 2 years ago now, that what we're seeing today in the Persian Gulf and in the Middle East was eminently seeable. Oil and oil stocks should have been higher a long time ago if historical precedents had held. Historical precedents did not hold. So over the last year or so, I've gotten a lot of criticism because oil stocks are not up, obviously. And people want to say, well, you're wrong and you should admit you're wrong. Well, wrong and early feel the same, but they're not the same. And what I've said about the Middle East and about the oil markets, it will all come to pass. The hard part as investors is absorbing that pain in the short term. And a year is short term. I know there are people out there that want instant gratification. They want their investments to be up a month later or a quarter later. It doesn't always work that way. Warren Buffett famously said, I can tell you what's going to happen. I just can't necessarily tell you when. What Warren Buffett focused on doing is take a look at the big picture, understand where things are going, and then buy assets when they were cheap. Sometimes assets got cheaper and he bought more. That's what we've done with the oil stocks. I am at my maximum asset allocation to oil stocks at this point, and I do a little trading to upgrade my portfolio from time to time, but really it's been rather minor. At this point, the calls that I have expiring in January of 2020, I'm looking for a way to get out of those intact. Right now, I'm not even hoping to make a profit on some of them. If I can just get around even, that would be swell. The longer term options to 2021, especially Pioneer Energy and Devon Energy, those are already even just on this little bump. So I think the thing we have to think about with oil is, okay, we were early, that cost us money, what do we do about it? I have people telling me sell, sell, sell. I'm not doing it. Now, do I have sell prices set? Yeah, I have sell prices set, especially on the shorter term calls. Those will be the things you want to get rid of first. The next thing that you'll want to get rid of is the XOP. Why? Because not all of the shale stocks are great, and I really don't want exposure to Chevron and Exxon because I believe that the litigation risk is not priced into those stocks a dime. I don't think there's a dime of litigation risk priced into Exxon and Chevron, and there is risk there. So you can poo-poo the idea that Chevron and Exxon have litigation risk, but at a minimum, they're going to spend hundreds of millions of dollars defending themselves, and they're probably going to lose at the end of the day, either in court or by settlement. Eventually, Chevron and Exxon will get broken up, as we've talked about, probably into 3 or 4 companies each. The pipelines will get spun off, the refiners will get spun off. It's a question of whether or not they get spun off together. Downstream, upstream, midstream, they're all going to be their own separate companies eventually. And the drilling company, right, the exploration company is going to be the one that probably falls apart first. But the refiners are going to have a problem at some point too, because the demand for refined products will fall about a decade or 15 years from now. So there's a limited window for them to pay down debts, while at the same time keeping their share price high enough that there's not a mass exodus, which means they'll have to pay dividends and buy back some shares. It's a very difficult line that the oil majors have to navigate as the world transitions to a more alternative energy future. Interestingly, if the price of oil goes up, not only do the oil companies make more money in a short to intermediate range window, 5, 6, 7, 8, 10 years, but the alternative energy companies become a lot more attractive. Why? Because they're competing with the fossil fuel companies. So as the costs for alternative energy fall, they become more attractive. But then the second thing is, as their competition becomes more expensive, alternative energy becomes more attractive. And interestingly, as we adopt more alternative energy, at some point, the lines will cross on the chart, and that'll crush the price of energy again, of oil and gas and coal again. Now, I believe that if the Democrats win in 2020, especially if they take the Senate, you're going to see coal pretty much wiped out. I don't know exactly how they would do it. I would think they would start with banning any new coal development and banning any coal exports. The next thing to do would be to tell the utilities, you have 5 years to cut your emissions in half. Those sorts of things are not unlikely, and frankly, I think they're desirable, and I think a lot of people agree with me. So if that is the way that things go, we have to be very cognizant of how timelines can get impacted. As we've learned, historical precedents did not hold with oil and gas. The divestiture movement was a big deal. And the alternative energy future is getting here a little quicker than we thought. So we need to, again, find ways to exit oil profitably during this last bull market. And the bull market's not going to last a week. It's going to last several years. And the price of oil generally goes up under Democrats. So because they want to stop using it. And the way to stop using it is to make it expensive for a while. Now that alternative energy is basically right there at about the same cost, we are in the end game here. The oil age is no longer, the end of the oil age, which I wrote about 4 years ago, is no longer in batting practice. Not even in the first inning. We're somewhere in the second, third, fourth inning at the end of the oil age. It took 4 years to get through 2 or 3 innings. Take 4 years to get through another 2 or 3 innings. That means that we've only got about a decade of oil demand increasing. And then it's going to start falling off a cliff. We want to be in those technologies that are going to grow 20% a year, 30% a year, that have catalysts and tailwinds supporting them. And the catalysts, again, we talk about big secular trends, we talk about government policy. The big secular trends and government policy are pushing alternative energies and starting to slowly shift against fossil fuels. That shift could accelerate again if there's a change in government power. Whether that's 2020 or 2024, whenever, who knows. But the demographics of America, the age of America, the aging demographics, with the millennials being overwhelmingly Democrat leaning, is probably going to push elections in a certain direction in the swing states, at least short term, and then probably long term. Who knows about the in between with political cycles? So what will we see coming, to the oil markets? Well, we probably see a conflict with Iran. President Trump ordered and then withdrew orders to attack Iran. He seemingly was bothered by the 150 deaths of people at those installations. Well, what does it take to tell them, hey, we're going to bomb you in 6 hours, get out? Doesn't take much. And that's probably what they're doing. So we want to be aware that there could be quite a Middle Eastern problem here in the very short term. That'll drive the price of oil up. That'll make all of these companies that we've been talking about even more profitable. And then we'll find our exit strategy after that. In the meantime, I'm going to go play poker. I'm going to head over to the Rio. The rumor here from every Uber driver and dealer is that the Rio is going to get torn down. I don't know if that's true or not, but one of the stocks that we're covering is Caesars. And I'm going to start talking about Caesars here in the next couple of weeks. I haven't talked much about it yet, but it seems like a viable turnaround play to me. Now, does that mean I want to jump into the stock right now? Not sure. I've sold a couple of puts, and I think that selling puts is probably the best strategy with Caesars unless we get one more big sell-off. What's going on with the company is that Carl Icahn and a big private equity firm are getting in there because the company has great assets and some great brands, World Series of Poker being one of them. And they probably can sell a handful of those assets to bring down the leverage on their balance sheet and still be turning out a ton of cash flow. At the same time, they reduce the leverage on their balance sheet. The Rio, I haven't torn apart yet. I don't know how profitable that property is, but the location of that property on Valley View and Flamingo, right on a highway ramp, is incredibly valuable. My guess is that that property gets developed as condos. Maybe they keep the casino, maybe they don't. And they make a lot of money. The football stadium is right down the road. There's a rumor here in town that Las Vegas is getting Major League Baseball. I have put the odds of that at about 20-1 against. So I don't buy into those rumors. But it's interesting stuff to hear the rumors from people that heard something from somebody who heard something from somebody who heard something who heard something from somebody who heard something from somebody that made it up. And that's a lot of what goes on in the stock market too. So in these articles that I've been writing, these blog posts, I've been equating poker to investing, but there's also a lot of false narratives out there. Just like a poker player might lie to you or get in your head a little bit, the investing world does that too. And there are people who say things over and over again, having no idea whether they're true, because they heard it from somebody who 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 made it up. And whether it's Tesla, which is gets that all the time, or alternative energy, which has the climate change deniers out there beating on it, or oil, which you have it from the other side with the divestiture movement. The divestiture movement's done harm to America. And that's the bottom line. If we had built the Keystone XL pipeline, we wouldn't be so involved with the Middle East. We wouldn't need to be. So there are a lot of extremists, a lot of people out there who will write a narrative or speak a narrative that isn't necessarily true. Why? Because it supports their ideas, supports their books. They're talking their book, they're talking their ideas, they're talking their motivations. We need to be very careful. And, I would just say here that I get accused of being very political. I'm analyzing things. What I want is way different than anything that's happening, right? I would love to see smaller government and lower taxes and a better safety net, and more education and less war, and a zero impact environmental footprint, right? I'd like to see all those things. Is it going to happen? Not in my lifetime. So what does the next 3, 2, 3, 5, 10 years look like? That's what I'm concerned about. Because ultimately, if you and I and anybody else who subscribes makes a bunch of money, I think most of the people listening here are good people. Maybe we can have an impact. Maybe that impact is just influencing our kids, our grandkids, our nieces, and our nephews. Maybe we get out into the community a little bit. I've refrained from getting involved in Milwaukee just because there's other people doing it, people I know, and I agree with a lot of things they're doing. However, I think that might change in the near future now that I've become a little bit more tied to Milwaukee. My daughter's having a baby. I'm not moving away anytime soon, although I do plan to keep traveling a lot. So maybe that office I'm opening up in October becomes a little bit bigger deal than I thought. We'll see. In any case, keep an eye on your oil stocks. Don't get too itchy on the trigger figure and say, oh, it's up 5%, I'm selling. Let it run. Makes a lot of sense that oil, for a lot of fundamental reasons, gets to the 80s. I know people are saying, oh, but what if there's a recession next year? And I think it's a coin flip. We get a shallow recession next year. I don't think we get any collapses. But what's going on in Hong Kong right now is a big deal, and it could help trigger the next recession. Take a look at what's going on in Hong Kong. Real estate has started to fall off a cliff there. People are talking about leaving the country. And if their credit system, which is one of the most highly levered in the world, falls apart, it'll have ramifications. And it won't be financial crisis type stuff, but it'll be significant enough to cause some realignment and probably trigger, a few bad quarters. So if we get that recession and oil demand flattens for a year, hey, oil demand flattens for a year. If we don't add 1 million barrels per day in 2020 of demand, does that crush oil? I don't know. OPEC's got a pretty good handle on it, and the frackers, the little itty-bitty ones, are going out of business, and the bigger guys are starting to consolidate and control their spending. I think that the price of oil gets to around 80. I think that it should have happened already. We'll see what that looks like. But over the next year or two, you probably get a rally in oil stocks, probably into the early 2020s. So don't be too short-term thinking about what just happened. Think about it in terms of a longer timeline and how you can hold to a higher point to sell at. We're not always going to buy right at the bottom. I'd say 2 out of 3 times we're pretty close, and that is outstanding. This time, we got our asses kicked, and now we're going to get our asses handed back to us, right? We get to get our asses back after they got kicked, if we can hold through the pain. That's all I got. I'm going to go play at the Monster Stack and hopefully find some players who are just happy to be there and get them to give me their ships. You guys have a great day. Not really any questions today, but we will have a lot to say in July, August, September, October. There's a lot going on out there. But, don't be too pessimistic. Don't be too optimistic. Play it by ear. Manage your asset allocation in line with your risk parameters. Take care.